Welcome to Bill the Lender podcast, devoted to educating you on a variety of financial subjects with an emphasis on real estate and real estate finance. Please click the button to subscribe to my channel so you don't miss an episode. Then like and share your favorite episodes. Assets is our fourth area, and assets come into play for folks who are more into investing than they do your primary residence. But every case is different, and what we're talking about is a person taking a look at your credit worthiness. My team pre-qualifies deals as they come in. We're the first line, if you will, from the street to getting you into the back office. And we advocate for you in front of an underwriter who is somebody that you're never going to meet to loan you money on a house that they're never going to see. So we have to get very familiar with your situation. And if there are any disagreements, let's say, we're the ones that actually advocate for you of your credit worthiness. We explain the situation so that you become lendable. That's what we do. Okay. So the assets come more into play for investments, but they're determined by this automated underwriting system, which is this mechanical machine that takes a look at a high level and see if you meet the basic guidelines of and parameters for a Fannie Mae or Freddie Mac loan. So it being sold and securitized into the secondary market because it's underwritten to the same specifications as every loan in the United States. Okay, for fair, equal credit opportunity and fair housing and all these types of things, we have to have a process that everyone goes through. Okay, now we take that first look. They do the automated. That automated may say, I need 3 months or I need 6 months. That's going to be depending upon your FICO score. That's going to be dependent upon the product. FHA doesn't typically require a lot of reserves. Conventional can. So how much you're putting down, what your credit profile looks like. There are a lot of things. So if it asks, you're going to have to provide some. Typically, if you're buying a primary residence, you don't necessarily need to document as many assets. The only assets that we're looking for are going to be the funds, obviously, that we're going to be using for close to pay for down payment and closing costs. Now, this asset piece, though, even though it's innocuous inside of this conversation, in terms of what I'm sharing and in terms of impact on choice, it does actually affect the program that you might choose, because whether or not you have a lot or a little, if you've got 20% down, you're probably going conventional to avoid mortgage insurance. If you've got, 3% down or 3.5%, you're going to be looking at different types of loans because you have limited funds, or you might be looking at down payment assistance. Okay. So the assets do come into play and influence this, but the biggest problems that we see that interrupt the mortgage process is actually documenting the assets needed for close, because we have to do it 2 weeks prior to close because, we're trying to get everything off to meet certain guidelines for disclosure prior to close. Because if we don't hit those guidelines for disclosure and you don't get a closing disclosure within, 3 days prior to close, you're not going to be closing on the date that you thought. So verifying those assets, the best thing that you can do is establish an account that is specific. You pick one out of many. You may have a lot. You pick one that you're going to put your assets to close in there. And then you put all that money in there and you make very few transfers in and out. If you put it into your checking account, and you show that statement to an underwriter, then depending upon the type of loan, if there are large deposits, and that's considered, depending upon the loan, anywhere from, half of your paycheck to $500 with FHA, you're going to be tracking down a lot of transactions if you're using an account where there's a lot of traffic coming through there. So pro tip right here, pick an account, and that's probably your savings account, where you know what's going in and where it's coming from, and you can easily track transfers. Because otherwise, you're going to spend a lot of time documenting things, and that's what makes the process tedious, particularly when you're like 2 weeks to close and you're like, dude, I thought this was all wrapped up. It's when we have to document issues and it gets tedious. This is usually why, because people are making transfers in and out. And it's just because, we try to have that conversation, but not everybody takes the advice. And then once they have one, and they do it once, and if it, they're tracking down a lot of checks and other accounts and things, like, oh, well, I won't do that again. I learned my lesson, right? So that's just a pro tip. I'm throwing that out here for those of you who are watching and looking for good advice. That's worth its weight in gold right there. And then breaking the 20% myth. Okay. I already talked about, if you have low money down, 3.5, 5, 10, 15%, you can do loans without having 20% saved. And in fact, if you're sitting on 5 to 10, then it's certainly a good time to think about jumping into the market, because waiting has cost you a lot, which I'll do a segment on as well, what the cost of waiting and what that looks like, and when markets change and how they've changed. That's going to be something that's coming. But you do deal with mortgage insurance, but there are a variety of ways these days to deal with mortgage insurance. And I'm probably going to go into the differences of all of these that I'm going to talk about in another segment, because we can do, 20, 25 minutes just on this. And I don't want to spin your eyes back in your head, because I'm throwing a lot of information at you. But, you can have lump sum, where you pay the cost of the mortgage insurance upfront. You can have lender paid, which means that it's rolled into the rate and you're not paying it monthly. You have the monthly mortgage insurance. You can do hybrid, which means you're paying a portion upfront and you also have a monthly, but it's reduced. So there's all of these choices in the conventional realm, in that private sector, in that 740 plus FICO score, 720 plus FICO score. That's what you're kind of looking at. FHA, you're going to pay mortgage insurance upfront and monthly, regardless of your equity position, whether you have 20% or not, if you need to go with FHA. But FHA solves a lot of problems that conventional cannot. Again, another segment. Now, finally, coming into the home stretch here, okay? Collateral. Collateral is the home itself. So whether you're trying to buy that entry-level home that's a townhome or a condo, or whether you're trying to buy that single-family residence, okay, or a duplex or a fourplex, all of that makes a big difference on the amounts that you have to put down, or the different underwriting guidelines for each type of property. Okay. Now, condos and townhomes are slightly different, and most people don't know why. And the reason why, it comes down to titling, because I've seen titles show a plot of land, and it looks like it's a side by side attached home and it should be a townhome, but when you look at the way it's titled, it's really titled as a condo. So it can be really confusing. But the good rule of thumb is that if you see the lot and the block in the description of the title work, it means that it's likely going to be a townhome. Okay. Meaning that you own the land beneath the property. If you don't own the land, then the only thing that you own is the air in between the walls, in between the studs. So you insure it differently. You have a monthly HOA in both cases. Some may be an exterior maintenance agreement on it on a townhome. But with a condo, a true condo, there's going to be an HOA that manages the exterior maintenance of the building. And they are higher risk because so much of the property's value is inherent to how well that HOA is managed. If it's not managed well, or it's not well funded, then the building is going to fall into a state of disrepair. There's also more inherent risk, right? Because if you go away on your European vacation for 2 weeks and the uh, tenant or the property owner above you has a pipe burst or water leak, that seeps and runs down your walls into your unit and does damage to you as well as them. And so that is why with condos, they have their own underwriting guidelines. And this is the only property type, by the way, where you can be well qualified and meet and check all the boxes for an underwrite and expect to buy any home that you want, but the property itself doesn't meet the specific guidelines of Fannie and Freddie. And some of those things are self-explanatory and some of the things are not. I'll give you an example. So anytime you have over more than 52% non-owner occupied, which means that you have non-owners or tenants living in the building, the thought process there from an underwriting standpoint is that because you have less owners living in the building and more tenants, that the building is going to be not as well taken care of. There's not that pride in home ownership. So anytime you see that exceeding that ratio, it's not going to qualify. It's going to be deemed as a non-warrantable condo. Now, if you're an entry-level home buyer and this is all you can afford and you're scraping together, 3.5 or 5% or 3%, whatever that number is, and now you suddenly hear non-warrantable condo, well, that just jumped up you, first of all, into a different loan class altogether, because now you're going to do a bank portfolio loan and they're going to require 20%. Well, that just dashed your, low money down dreams of home ownership. So it's really important that your realtor only show you the homes that they know will qualify for financing. Or if you're looking at a property that you're investing in and it doesn't qualify for traditional financing, that you've had a conversation with the portfolio lender so you understand what those terms are going to be. Because most portfolio loans are not 30-year fixed loans. They may be amortized over 30 years, but because banks make their money on lending it, they can't hold something like that for 30 years and tie up that money. They can only do it for 3, 5, and 7-year arms. Your fixeds are usually going to tend to be on 10 years or 15 years, and that is just going to up the cost of living there. Now, if you can afford it, great, but a lot of people can't. So it's something to note, okay? Now, single family, pretty straightforward. You own the land. Townhomes, again, even if there's an HOA, as long as you own the land, you're going to be in good shape. It's not going to require that separate property approval on the collateral, and you should qualify just fine as long as you also qualify with that HOA in addition to the overall principal and interest, taxes, and insurance. Okay. Then duplexes and fourplexes are just going to require, fourplexes are going to require a minimum of 25% down, unless you're doing it FHA and you're going to live in the property. If you live there, it's going to require less down, but you're still going to be, 3.5% down. You can live in a duplex with 3.5% down through FHA. But fourplex in a threeplex, the more units, the more you're going to have to put down. So that is also something to note that's going to affect that. Now, then, of course, the other thing is that the property has to appraise, right? Because the contract represents the retail value of the home, and the appraisal is considered the objective third party verification of the value of the home, so that the bank knows that they've got a bankable asset that's worth what you're going to purchase it for. So that's why the appraisal is there, and that's why it's important. And then that appraiser is going to be the bank's boots on the ground, because again, we're not going out and visiting every home we finance. So we require some tactical person to be the boots on the ground to verify that this home has the amenities that were advertised, and that it's a freestanding structure, and that it's not encroaching on other people's property lines, that there aren't concerns that have to be mitigated or addressed, right? And if there are concerns that come up in the appraisal, if there are things that need to be addressed, then they're going to have to likely be fixed prior to close, depending upon what they are. And we have a lot of flexibility at Cornerstone, but typically, if it's infrastructure related, right? So if it's a water heater or a sewer issue or something that makes the house non-inhabitable, meaning it doesn't matter how many toilets you have if you've got a broken sewer line, right? You can't live there. So that has to be fixed prior to close. Typically, we won't escrow outside of that. It needs to be fixed prior to close. We have made exceptions in some cases, particularly in this market, because, people take their houses off the market if they don't get what they want and they sell it to somebody cash. I mean, this is a reality. So sometimes we have to be flexible, but by and large, the general rule of thumbs is big ticket items. Like if you've got a roof and it's a $10,000 replacement, that might be okay. We can escrow 1.5 times after the fact for the seller and you to contribute funds so that it can happen after closing, or the seller can pay the roofer direct out of the proceeds of the sale, right? So they can give that $10,000 check direct to the roofer, and that work can get done after close. But we still have to hold that lock open, which means that, and let's talk about this, understand this. So we're making a loan, we're underwriting under basic guidelines. Fannie and Freddie says, I need a good roof. I need this property to be habitable, structurally sound. And if there's an issue that you know about, then you need to show me that you've done your due diligence and then collected the documentation to show that the work has been completed. Which means that if you're looking and buying in a 30-day window, in order to get the roof fixed, I might have to hold that lock open, or that interest rate may need to be locked longer for us to make sure that the work is done and then deliver the loan after the work is done under the terms that we've agreed to, because we are contractually obligated to write good loans. You're contractually obligated to pay us back at the terms that we write, if that makes sense. So again, high level, hopefully great information, gave you a broad strokes on quite a few areas, and we've identified, it sounds like, quite a few other episodes to talk more about. This is Bill Rodriguez, and my podcast is dedicated to consumers like yourself, but also to financial service professionals. And all things financial services related are going to be discussed here to help you better understand the world of real estate and how it's influenced and how your money makes a difference. Again, until next time, we'll talk to you soon. Bye-bye. Thanks for listening to Bill the Lender Podcast. Please reach out to me with any questions at 303-877-6323.